Greetings, it's me, Dr. Paul Gerhardt. How much is a company actually worth? It sounds like a simple question, but in mergers and acquisitions, the answer can determine whether transactions create enormous value or become an expensive mistake. A seller may believe a company is worth $100 million. A buyer may believe it's worth $80 million. Another buyer may be willing to pay $120 million because that company sees the strategic opportunities the others do not. So who is right? Potentially all of them. That's because price and value are not the same. Welcome. In this 9th video of our mergers and acquisitions videos, we're going to examine the fundamentals of business valuation, including the major valuation methods: discount, cash flow, comparable companies, startup valuation, and how valuation influences merger negotiations. More importantly, I want to help you think like a manager rather than simply memorize financial formulas. By the end of this lesson, you should understand not only how companies are valued, but also why reasonable people can arrive at very different conclusions about the same business. So, what about price that is not the same as value? Let's begin with perhaps the most important idea in this lesson. Value is an analytical estimate. Price is what someone actually agrees to pay. Imagine that a company is worth approximately $80 million based on its current operations. A strategic buyer, however, believes that acquiring the company will allow it to eliminate duplicate costs, reach new customers, and increase sales. To that buyer, the company may be worth considerably more. This gives us several ways to think about value. Standalone value is what the company is worth under its existing strategy. Control value reflects the additional benefits that may come from controlling the organization. Strategic value includes benefits that a particular buyer believes it can create through the acquisition. And finally, there is the transaction price, which is what the buyer and seller ultimately negotiate. The managerial lesson is important. The same company can legitimately have different values to different buyers. That's why valuation should rarely begin with the question, what is the company worth? A better question is, worth to whom, under what assumptions, and for what purpose? The major approaches to valuation draw from three broad approaches. Income approach. The income approach asks, how much are the future economic benefits of this business worth today? The best known version is discounted cash flow analysis. Instead of simply looking at what the company earned last year, we estimate the cash the business may generate in the future and then discount those future cash flows back to their value today. Why discount them? Because receiving $1 million 5 years from now is not economically equivalent to receiving $1 million today. There is time involved. There is risk involved. And there's alternative uses for that money. The market approach asks, how are investors valuing similar businesses? For example, suppose similar companies are trading for approximately 8 to 10 times their expected earnings before interest, tax, depreciation, and amortization. We might use that information to develop a valuation range for the company we are studying. But there's an important warning here. No two companies are identical. One may be growing faster, another may have stronger margins, one may depend heavily on a single customer, another may have much more debt. So comparable companies provide evidence, not automatic answers. The asset approach asks, what are the company's assets worth after subtracting its liabilities? This approach can be particularly useful for businesses with significant real estate investments, natural resources, or other tangible assets. It may also become important when a company is distressed or being liquidated. It can underestimate businesses whose real value comes from brands, intellectual property, employees, customer relationships, or future growth. That leads us to another important principle. Strong valuations usually use more than one method. We compare the results and ask whether they tell a coherent economic story. Why we do not simply average several numbers together and assume the answer must be correct. Discounted cash flow and the importance of assumptions. Discounted cash flow analysis is one of the most important, powerful valuation tools because it forces managers to explain where value actually comes from. The basic idea is straightforward. Forecast future cash flows. Estimate the risk associated with those cash flows. Discount them back to their present value. Then estimate the value of the business beyond the detailed forecast period. That final component is called terminal value. And this is where managers need to be particularly careful. In many discounted cash flow valuations, terminal value represents a very large percentage of the company's total estimated value. That means a small change in assumptions about long-term growth or the discount rate can dramatically change the answer. Suppose one analyst assumes the business can grow at 3% indefinitely, while another assumes 2%. Or suppose one uses a 9% discount rate while another uses 11%. Those differences may seem small, but they can produce significantly different valuations. This is why I tell my students a valuation model is not valuable because it produces a precise number. It's valuable because it makes assumptions visible and testable. A spreadsheet might tell you that a company is worth $83,427,000. That doesn't mean anyone actually knows the company's value to the nearest dollar. The calculations may be precise, the assumptions are not. Good managers therefore examine a range of possible values. They ask, what happens if growth is lower? What if margins decline? What if interest rates increase? What if integration costs are higher than expected? What if the business requires significantly more investment to support growth? This is called sensitivity and scenario analysis, and it is one of the most important parts of reasonable valuation. Another common mistake is focusing too heavily on accounting earnings. Earnings are not the same as cash. A company can report impressive profits and still have serious cash flow problems. Perhaps customers are not paying quickly. Perhaps inventory requirements are increasing. Perhaps the business requires major equipment purchases. Perhaps reported earnings include temporary or unusual benefits. That's why managers should examine the quality of earnings and ask questions such as, are revenues reoccurring? Are customers actually paying? Are profit margins sustainable? Are the usual expenses here or gains? Does the company need substantial reinvestment to maintain its growth? And does reported profit eventually become real cash? This is especially important when valuing privately held companies. Private company earnings may require adjustments for owner compensation, personal expenses, related party transactions, unusual costs, or other items that would not continue under a new owner. But managers should be cautious about becoming too aggressive with those adjustments. If we remove every expense we dislike, eventually we create fictional earnings. Every adjustment should have a defensible business reason. Another distinction managers need to understand is the difference between enterprise value and equity value. Enterprise value represents the value of the operating business available to the company's capital providers. Equity value represents what belongs to the common shareholders after considering debt and other senior claims. A simplified relationship is enterprise value minus debt and other senior claims plus appropriate cash and non-operating assets equals equity value. Why does this matter? Because a company can have an impressive enterprise value and still have sustainably less value available to shareholders if it carries significant debt. This is also why valuation multiples need to be internally inconsistent. If we use enterprise value in the numerator, we need a financial measure associated with the entire enterprise. If we use equity value, we need to measure associated with shareholders. Mixing two creates misleading results. Startup valuation creates an entirely different challenge. A mature company may have years of revenue, earnings, customers, and cash flow information. A startup may have almost none of those. Instead, much of its value depends on what might happen in the future. Will customers adopt the product? How large is the realistic margin? Can the company retain those customers? Will margins eventually become attractive? How much additional financing will be required? Will future investment dilute existing owners? And perhaps the biggest question, will the company survive long enough to reach profitability? This is why startup valuation requires a credible story supported by numbers. The story should explain the customer problem, market opportunity, revenue model, competition or competitive advantage, growth path, margins, reinvestment needs, financing requirements, and major risks. Then the numbers should reflect that story. A powerful principle here is numbers without a business story are fragile, but a business story without numbers is vague. Startup investors may use several methods. They might develop scenarios based on discounted cash flow models. They might examine comparable financing rounds. They might estimate a future exit value and discount that value back to today using the venture capital method. But no method eliminates uncertainty. For startups especially, valuation should evolve as evidence improves. A prototype creates new evidence. Customers create new evidence. Revenue creates new evidence. Customer retention creates new evidence. Each milestone can change valuation. Now consider what happens when valuation moves into an actual merger negotiation. The buyer and seller have very different concerns. The buyer asks, what can we earn from this investment? How much integration risks are we accepting? How much of the accepted synergy should we give the seller? And what happens if our assumptions are wrong? The seller asks, what are we giving up by selling? What could this business be worth if we remain independent? How much of the future value should we receive today, and how certain is the buyer's offer? This is why merger negotiations are not simply disagreements over one valuation number. They're negotiations about how future value and risk will be divided. Suppose a business has a standalone value of $80 million. The buyer believes it can create another $30 million in synergies. That might suggest a strategic value of $110 million. Should the buyer pay $110 million? Probably not automatically. If the buyer gives all expected synergy to the seller, the buyer receives little compensation for the cost and risk of achieving those synergies. The negotiated price might fall somewhere between standalone value and the buyer's maximum strategic value. Where it falls depends on the competition, bargaining power, alternatives, deal structure, and confidence in those expected benefits. Now let's talk about cash versus stock. Valuation also affects how an acquisition is paid for. If the seller receives cash, the value is relatively clear at closing. If the seller receives a stock, the situation becomes more complicated because the buyer's shares become part of the currency. Now, the seller must evaluate two businesses, its own company and the buyer. Consider a simple example. Suppose the buyer's stock trades at $50 a share and the buyer offers 0.8 shares for every target share. Initially, those 0.8 shares are worth $40. But if the buyer's share price drops to 40 before closing, those same 0.8 shares are now worth only $32. If the buyer's share price rises to $60, then they are worth $48. This illustrates why exchange ratios, floating ratios, and collars matter. They determine which party bears the risk when market prices change before a transaction closes. Deal structure is therefore part of valuation. So let's talk about the 5 valuation mistakes managers should avoid. Let me close the main discussion with 5 mistakes. And every manager should recognize these. Mistake number 1 is false precision. Do not confuse mathematical precision with economic certainty. Present valuation ranges rather than pretending one number is unquestionably correct. Mistake 2, biased comparables. Do not select only the companies or transactions that support the answer you want. Comparable selection should be based on economic similarity rather than convenience. Mistake number 3, double counting. Do not count the same benefit twice. For example, if expected cost savings are already included in the projected cash flows, do not add those same cost savings again as a separate strategy. Mistake number 4, ignoring reinvestment. Growth is rarely free. More customers may require additional employees, inventory, technology, equipment, marketing, or working capital. Revenue growth without the required investment can dramatically overstate value. And mistake number 5, treating valuation as the decision. Valuation is an important decision tool. It's not the entire decision. A transaction can appear attractive mathematically and still fail because of culture, leadership, integration, strategy, execution, unrealistic assumption. So here are the takeaways. If you remember only a few ideas from this lesson, remember these. First, price and value are different. Value comes from analysis, price comes from the market or negotiation. Second, there are no single valuation methods that works perfectly for every business. Managers commonly examine income, market, and asset approaches together. Third, discounted cash flow analysis is powerful because it forces us to connect value with future cash generation and risk. Fourth, valuation should normally be expressed as a range rather than one supposedly perfect number. Fifth, startup valuation requires special caution because much of the value depends on future performance that has not yet been demonstrated. Sixth, in mergers and acquisitions, valuation is also about determining how expected value and risk will be divided between buyer and seller. And finally, the quality of valuation depends more on the quality of its assumptions than to the complexity of its spreadsheet. So, in conclusion, valuation is ultimately a disciplined way of thinking about the future. Managers are asking, what cash can this business realistically generate? How risky are those expectations? What investments will be necessary? What alternatives exist? What could make our assumptions wrong? And finally, what price leaves enough potential value to justify taking the risk? The last question is especially important in mergers and acquisitions. Winning the bidding contest does not necessarily mean winning economically. Sometimes the best acquisition decision is knowing when the price has moved beyond the value you can reasonably create. If this lesson helped you better understand how managers think about business valuation, subscribe to the channel for additional lessons on mergers, acquisition, leadership, strategy, and organizational decision making. Thank you so much for joining me, and I hope this lesson helps you look beyond the numbers and think more critically about what a business is really worth. And more importantly, I hope that you have a great day because only you get to choose how you feel about it. I'm Dr. Paul Gerhardt.